Markets shrug off another high CPI print as bond yields break lower. The Nasdaq reaches new all-time highs, and commodities correct ahead of the Fed this week. All this and more in this week's Macro Insight. Okay, so welcome back to Macro Insight, guys. Today is the 15th of June, and let's take a look at these markets. So last week, the main event of the week was obviously CPI. So CPI came out, higher than expected. And let's sort of have a look at the report and see, drill down into it a little bit. So this is what we had. We had US CPI report, and the sort of the big things, big highlights, I guess, if you want to look at kind of the year-on-year change. Obviously, energy kind of being the main culprit, highlighted there, where you're seeing 50 to 30% increases year-on-year. But the big thing for month-on-month changes that's kind of been creating these big spikes in the last couple of months has been used cars and trucks. We also had quite big numbers on transportation services. And what we were watching for as well was whether shelter was kind of on an uptrend, right? And, looking at these numbers, you can see used cars and trucks, whereas in April came in 10% up, they were only 7.3, so starting to come down. Still a big number, but trending back down. And same with transportation services, right? So, there's been this big kind of call from the Fed saying that it is going to be transitory, and people are looking in the data to trying to read whether or not that is the case, right? And the market clearly signaled that they believe the inflation to be transitory, and they think it's likely we've seen a peak. And so we saw the reaction from the bond market, and we saw the reaction from the equity market, right? So let's have a look at those charts to see. Here you have the 10-year. So we had been in the range from about sort of low 150s to 170 for quite a while. And then last week of all weeks on that big inflation print, we break to the downside in yields, right? And yields got as low as 143. So we took the bottom of the range out by 10 basis points. We've recovered a lot of that now. But the point being now that 150 to 153 area is likely going to be a resistance on the first test now, right? So yields for now are telling a story that, yes, we're not so concerned about inflation, and we kind of buy into the Fed's narrative, basically. So that's kind of what the yield story is saying, right? So breaking below 150. Now, the bond market often knows the truth, right? The bond market is often kind of thought of as the market that really knows what's going on in the economy and gives you a better read on what to expect on the economy going forward, whereas the equity market, not so much, right? So then you've got to ask yourself, well, what is the bond market signaling then on the economic front? Because two things that it's basically saying, right? Either inflation is going to slow back down and we're going to continue growing, right? Which is called a Goldilocks scenario, right? Higher growth and lower inflation going forward, which is very, very bullish for risk assets normally, yeah? Or it's signaling that we're going to get a more deflationary scenario where, and we don't mean negative necessarily, we just mean slower growth and slower inflation going forward, yeah? And that's kind of obviously the outlook for asset prices on that scenario isn't so great, basically, right? So depending on which one we get, the outlook's very different for risk assets, yeah. But that's kind of what the bond market is signaling, that we're heading away from the higher growth and higher inflation, which is reflation kind of conditions, to one of the others. Okay. So then looking at equities, what happened there? Well, in the kind of Goldilocks sort of state of play, that's good for stocks and particularly for tech stocks. So we saw NASDAQ back to the highs, right? So we got NASDAQ literally yesterday popping its head back above 14,100 and making new all-time highs. S&P, on the other hand, seems to be struggling a bit more. It's been ridiculously range bound, as you guys know. Kind of been stuck in that 4,200 to 4,250 range. But that range seems to be shifting higher a little bit, right? So whereas before, the week previous, it was like 4,160 to 4,200. Now it's 4,200 to 4,250. And we've been talking a lot about the positioning, right? So we've been watching what the vols been doing, what the gamma positioning of the street looks like. And this 4,250 area, 4,250 to 4,300 area seems to be a concentration area where dealers do have a lot of gamma. And we've got the quarterly expiry coming up this Friday. So that would kind of exacerbate that generally as you head into one of those big expiries. If the street is long gamma, they're probably long options of that expiry. So that gamma is kind of this week is at its maximum basically, right? So that's going to make it pretty hard for the S&P to kind of go anywhere, right? And we're definitely seeing that when we look at realized volatility numbers. So we bring up the VIX. Yeah, there's the VIX curve, 16.5 in the June futures, which is kind of in line with spot now. 19 in July, 20.5 in August. A very steep contango, as you'd expect in a low vol environment. But the realized vol for me is just the interesting one. 10 days at 5.5, 20 days at 7.5. Okay, that's about as low as you're going to see, right? So going into the summer, you do often get quiet markets, but this is pretty much as quiet as it gets. Yeah. And then you bring up the VIX chart, and we saw that collapse on the VIX. Kept saying, every high that the VIX makes is lower and lower each time. It briefly popped to around 18 and a bit, and got slammed straight back down to 15 last week, right? Right now it's hanging around at about 16.5. I suspect at the margin, there's probably some more vol selling to be done into tomorrow's VIX expiry and certainly into Friday, June expiry. A lot of systematic selling flow. So we could definitely see that VIX get to a 14 handle before the week is out. I wouldn't be overly surprised. We kind of need, and given the gamma positioning, it's going to be hard for the market to break away from here enough that we're going to see a significant VIX spike, right? So I would kind of favor the base case scenario that we're likely to see sub 15 VIX in the not too distant future. Yeah. And then, all the eyes and ears are going to be on the FOMC meeting this week. Right. So to see if there's any mention of tapering or what they're thinking on rates. Now, Paul Tudor-Jones was out saying that this meeting could be the most important meeting that Powell's had in his whole career. Sounds to me like he's long vol, right? I personally think this is probably the easiest meeting for Powell to just stick to his transitory inflation narrative, which the market has been confirming for him. Yeah, it's not like the bond vigilantes are going after him, trying to force them to do something on rates. The market's agreeing with the transitory narrative. They've been saying it all along. The employment data is kind of showing no signs of being crazy strong. So, it's all in line with what they want to say, right? And the vol market for me, if we look at cross-asset vol markets, FX, rates, equities, they're all pretty subdued, right? So all the vol markets are kind of thinking this is a pretty low-risk event for FOMC this week. So I don't know. He's a smart guy, Paul Tudor-Jones. He's a lot better and more successful than I am at investing, but I don't see it this week, and I don't see it being such a big deal, this FOMC. And if you look at it, this market, every piece of data that comes out, whether it's non-farms, whether it's inflation prints, market doesn't really know how to react to it, right? Because there's so many counterbalancing forces at the moment and there's so many distortions. We're still coming out of the pandemic. We're comparing ourselves to base effects from the real lows of the pandemic and the recession last year. I think it's hard for the market to react to data in a really significant way. So I'm not surprised volatility markets are down here. because markets are just a bit confused right now, and they need to see more data to figure out where the trend is going to be and where are we going before they can really make their mind up. That's kind of how I read markets at the moment, right? I do think the likely scenario is, risk on for equities and commodities higher and the dollar lower, right? For the next sort of, at least the next month or so, as the Fed likely reassures the market on loose policy until significant labor market improvement. I think we'll probably see the inflation numbers cool down over the next couple of months. We might see the job numbers improve if people are kind of incentivized to get off their unemployment benefits as well. So all these things are happening. You've also got Europe and EM kind of reopening and getting their vaccines rolled out, which should be relatively supportive. So, still kind of think European equities can continue sort of grinding higher. As you can see there, Euro Stoxx is at its highs. DAX, same thing. They're not really accelerating higher, but they are grinding their way higher. An interesting market to kind of keep an eye on, maybe Nikkei. It's been in the doldrums a little bit, but it's a cyclical play, right? So, some people are suggesting the Nikkei might have a catch-up trade in it, where it was kind of hampered a little bit by COVID, but it's coming out the other side of that as well, and maybe a 5 to 10% charge in Japan to catch up with some of those other cyclical markets, maybe the obvious sort of trade that presents some value right now. So I'm kind of looking at that. I haven't really figured out how I want to play it, if I want to play it yet. Maybe waiting for a little bit more price confirmation of that thing rallying, and then I'll have a look. Maybe some simple call spreads, relatively short dated call spreads might make sense for Japan, right? Vol generally isn't quite as low, I don't think, in Japan as like some of the other markets like S&P or Europe. So that's why I probably favor call spreads as opposed to outright calls. Yeah. And then what's the risk, right? The risk is, probably more likely for Q3. But if you look at some of the economic surprise indices, like for China and the US, which have been leading markets, if you think about coming out of the pandemic, those economic surprise indices have been rolling over, right? And they're suggesting that things are slowing down a bit. And we know that the stimulus benefits are meant to be rolling off in the autumn. So all these things are likely gonna affect it. And then you've got the Fed likely to talk about tapering sometime around Jackson Hole. Some people are thinking that might be the date. So you've got a few forces that are moving in the wrong direction. If you think about rate of change of growth and kind of fiscal policy, they're talking about taxing more and obviously spending less in terms of stimulus. And on the monetary policy front, you'd have to expect some kind of potential signals on when the tapering might happen. So things are all moving a little bit in the wrong direction as we go through into Q3. So there might be a wobble in markets around Q3 as potentially like what we're probably setting up for. Yeah, that's what I'm starting to think. Yeah, I've heard a few people kind of say that as well, and I think they're quite on the money. So that's what I'd be looking out for. Yeah. In terms of coming up this week, the main sort of data points on the macro are, you've got retail sales in the US, again, maybe a bit of a lead indicator. You've got Empire Manufacturing and US PPI today. And then you've got Wednesday, China retail sales and FOMC, obviously. So FOMC is the big one, supposedly the big one. Personally, I don't think it's going to be a massive event, but obviously the market's going to have its eyes fixated on that. Yeah. Okay. And then let's move on to FX. So the dollar, I have been flagging that I thought the dollar was running out of downside momentum and was looking for a bounce. But to be honest, I call this the slowest bounce ever, right? I mean, it definitely has based, and you've seen a bit of momentum basing, and you've seen the market kind of finding a base and struggling to go any lower in the face of like increased dollar shorts. That's what made me think maybe we get a bounce. But we've got that bounce despite lower yields in bonds, right? But the bounce is pretty unconvincing so far. So maybe the reason the bounce hasn't really got any legs is because bond yields have kind of gone lower. Let's see what comes out of the FOMC. but it's hard to see a hawkish surprise, I think, coming out of the FOMC right now. Yeah. Which is probably what the dollar needs to have a real rally. It probably needs a more hawkish surprise out of the Fed to get that bounce going. Yeah, and I'm kind of not really thinking that's what the Fed's going to deliver. I don't think it's in their interest right now to deliver a hawkish surprise to the market. Yeah. And then overall, FX has been pretty boring, right? FX has not done much. The majors like euro, pound have kind of been, very, very low vol. Pound's kind of probably looking a little bit worse. I would say we delayed the reopening slightly. We were going to have Freedom Day this week. That's been delayed by a month into July, where they're going to lift all restrictions for the UK. So maybe that's been taken a little bit negatively on the pound. But if you look at it, I mean, it's barely moved, right? 142 and a bit back to kind of 140. It's not a huge move. The uptrend's still very much intact. So, you'd think there's probably going to find some support around the 140 area. So for people looking to play a tactical long in the pound, 140, probably not a bad spot to maybe try one. But that's kind of what that looks like. I mean, I think against the EMs, you look at dollar versus Brazil here, that's been a lot weaker. So some of these EM currencies and EM markets have had a bit of a rally recently. So, as they're kind of coming out of the pandemic as well and things like that. I'm not playing that at the minute, to be honest. I'm just kind of waiting and watching at the moment to see what the dollar wants to do. The vols it's just so range bound that the moves just don't really feel like they're worth playing because they're so small. A while back I had flagged dollar CAD as a potential way to buy the dollar. That looks very similar to the DXY chart, right? It's formed the base, has started rallying, but then oil's continued rallying as well, right? And part of that trade was to try and play a correction in oil, which never came. So I kind of bailed out on that trade, right? So anyway, so that's FX, pretty uninteresting for me at the minute. Commodities, bit more interesting, right? Oil breaking higher. So I said if it took out 68, it was going to have a charge. I did go long there. It's kind of done that. It's kind of approaching 72 now. My target was closer to sort of 75, but over a slightly more medium-term horizon. OPEC are basically calling for 68 to 75 as their range for oil, and they seem to be doing a pretty good job of manipulating where they want to take that price right for now. So no need to fight them right now, I would say. What the market's been doing in commodities, it seems that longs have been added to energy, and they've been trimmed from the likes of metals and the ags, right? So if we bring up some of the performance in commodities, so you can see here that so you've got the energy, you've got nat gas, crude oil, gasoline, all of those performing well. June so far this month. So the energy sector is the one that's really going, but you've got grains, precious metals, softs, and industrial metals all weak, right? So they're all underperforming. Okay, so that's kind of shows you the performance in terms of how the positioning has kind of been moving around. This chart kind of shows some of the futures positioning across those different kind of sector pockets within commodities. So you can see energy is kind of, quite a big share of that still, whereas, the share of metals and the share of ags has been reducing somewhat. And you can see that from the column on the table with the change in positioning. But I would say the grains positioning is still pretty lumpy, right? It's pretty large, yeah. And there has been some, weakness out of the grains recently as, people are looking at the weather, expectations for the weather to cool down in parts of the US Midwest. Some better yields coming out of Argentina on corn. Russian wheat crops are forecast got raised following some rain in May. So a few, like I mentioned in previous calls, the grains market, supply and demand in that market is very susceptible to swinging around based on things like weather, which are not so easy to kind of read and not so structural. Whereas, in metals, maybe it's a bit more structural. Now, having said that, if we take a look at copper's actually had a bit of aggressive pullback today. And again, I had been flagging that I thought copper was at risk of a pullback. So if you wanted to buy some copper, you were probably going to get a better opportunity. So I'd lightened up on some tactical longs around, I think it was around 460. We're back down to 435 today. I have rebought some at 435. I'd probably add to that position in the 420, 410 area. But you see here, you've got the chart on copper. So, it's pulling back towards this sort of old high, which should act as a bit of support first. But you see the managed money positioning is rolling over. So you've definitely got some position liquidation coming out in the copper market. And you've got this LME cash to 3-month futures premium and the Chinese premium over LME. So this gives you a feel for like how tight the copper market is by where these premiums trade. And you see they're all rolling over, right? So it's kind of showing you, certainly in the short term, there's probably been a bit of overstocking of copper, which is now leading to these premiums to roll over because people have kind of got the copper they need in the immediate term. So that's why you're seeing a bit of a correction in this market, right? So I think copper definitely got room to correct a little bit more. I think it broke the 50-day moving average, which it had held it for a while. It's broken that now. Let's see how deep it goes. The structural trend is there. It's going nowhere. So I just think, you kind of pick your spots to accumulate as it comes off, but kind of getting into that trend longer term, I still like, and I'm still in it, right? I'm still in it structurally, but in terms of my tactical positioning, I'm kind of trading around it a bit, basically. Yeah. Okay, so that's where I'm kind of thinking on commodities, but then you've also got, structure, back to the longer term story in commodities, right? With stock and bond correlation being quite high as it has been recently. Think about risk parity funds. Risk parity funds will start where bonds don't offer them the diversification that maybe they once did. They're going to be looking at other ways to diversify, right? So commodities, if you look at commodity to stock correlations, they're close to zero, right? And so you might find a situation where, as a bit of inflation hedge, as a bit of decorrelation from bonds and equities, that they have to bring more commodities into their portfolios, right? And if you look at where commodities are on a long-term picture, Crescat put out this chart, commodities to equities ratio, going back, to the 1970s, right? And I mean, the chart speaks for itself, right? So commodities versus where they've historically been compared to equities are nowhere, basically, right? So they're, from a long-term, decade-long type view, you've got value in diversifying into commodities, basically, right? If you're looking at a long-term pension fund, it's kind of a no-brainer to start switching some exposure into commodities if you don't already have it. Right? I personally already have it and have had it for at least 6 months, like 12 to 6 months. But for people who haven't got it, you look at that graph, doesn't really look expensive still on a relative basis, right? And then the last thing to say on commodities is really gold, right? So gold had its break, charged up to 1915, rejected that, has pulled back, and so far has held these levels as support, right? So for me, the main support zone is this kind of confluence of moving averages and trend lines support. So around the 1825 to 1840 area, for me, is the level that gold probably needs to hold on the support. So buying any dips in gold or even buying it here is probably fine with a stop somewhere around there, basically. And then, or even just below there. So 1800 to 1810, maybe. If you have a stop somewhere around there and you accumulate gold here, gold seems to have kind of started its next leg higher. So this dip is probably presenting you some position building opportunity, I would say. Yeah. I had bought some tactical longs in gold on the way down yesterday. I kind of reduced them a little bit because I wanted to rebuy them at 1840, which I didn't get to. I still got some, but I'm just kind of playing around trading that position at the moment, basically. Right, but that's kind of what I'm thinking. Below 1815, then that if that support is clearly broken, then it's kind of not really sure what gold wants to do. Yeah, and gold, to be honest, has been, if you look at, I'll bring up this chart. this chart kind of shows quite clearly the impact Bitcoin has on gold, right? So that since December, if you look at those swings, they're pretty closely, it's the inverted chart of the Bitcoin and gold's chart. And you can just see basically every time Bitcoin rallies, gold sells off a bit and vice versa. So we literally just had a rip from Bitcoin from like the low 30,000s back to 40,000. That's generally not going to do great for gold in this current sort of correlation that it seems to have. This correlation regime with Bitcoin seems to be quite dominant at the moment, basically, for gold, right? So we'll see if it can break away from that. But for now, that seems to have an impact. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.